Good afternoon, welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is August 14th, 2025, and we're going to talk about CPI versus PPI and whether we should be betting on cuts or no cuts, inflation, no inflation, or really what should we be betting on, small caps and financials, or should we be betting on staples and utilities? We'll get to that here momentarily, but to start, I do want to highlight some things about CPI versus PPI. CPI is Consumer Price Index, and CPI Consumer Price Index is usually used to tell us whether things cost more for consumers. Simple enough. And if things cost more for consumers, it means that we have inflation, and that's our top inflation measurement, especially the one that is CPI PCE, personal consumption and expenditure. Now, this week is not PCE. This week is just the core CPI, year CPI, and month CPI in the move here. And when we saw CPI, Consumer Price Index, pull back from 2.8 expectations to 2.7, everybody treated that like, hey, inflation's under control, it's falling, and therefore we can cut rates. And they started pricing in rate cuts. We saw the rate cut for September jump to a 95% probability, and some had it at 100% locked in that we were going to have a cut in September. But reality is, it was the exact same number as the previous report. We didn't change. It's the same rate. We're still inflating at the same rate. Today changed that view. So PPI, Producer Price Index, is oftentimes treated like it's wholesale prices, and I agree with Garrett and others that it is not. It is the cost of doing business for producers. Now, it depends on elasticity of demand. It depends on what they have as far as margin. It depends on a lot of things. But generally speaking, they don't pass on cuts to the consumers, but they do try to pass on cost in many cases. This was a big deal because inflation is still being seen and felt by producers. So the manufacturers and the producers inside the United States, whether we're talking manufacturers of textiles or mining or whatever, we're talking about the cost of transportation, cost of wholesale or warehousing. Those types of things went up, and it went up 0.9%, one of the largest jumps we've seen since 2022. In fact, when we cross the 1%, that is usually an indication that you're going to see a significant increase in cost being passed on from producers to consumers. And whether they do or not is kind of irrelevant with the way we're going to react today. If that inflation number is back, instead of 0.2% for a month like we saw in CPI, and this is early indication because they can take a while before they pass that on, or they can absorb it, it's still 0.9%, and that 0.9% is going to tell us that prices are up a lot more than flat, than what we saw in CPI being 0.2 to 0.2, we're up 0.9. So the expectation is, oh, well, inflation's still here. Inflation's here to stay. And so we unwound, we deterred, we reversed the moves in bonds to say maybe we aren't pricing in that rate cut. Surprisingly, the CME's Fed Watch tool only went from 95% to 90%, but the math that I ran on it shows us dropping from 95% to 58% probability when we look at the Fed Funds Futures pricing. So, significant change. Significant response, significant reversal. If that was the case, if we said, oh, but not only did we not have a slowdown or a reduction of inflation, we're actually increasing it, theoretically, we should have reversed everything that we saw yesterday and gone even further. No, so that means if things were up, they should have gone down. If things were down, they should have gone up, equal to greater than the reaction we got yesterday. That didn't happen. Let's go through a couple of charts and show you what we're seeing. This will be easier to see on the ES futures, but I do want to start with the SPY. SPY gapped up, traded up, and gapped down, erased the regular trading hour day, filled the gap from the previous day, and then bounced. We should have stayed down here and continued lower based off the data alone. If we were purely going off the data and saying we gapped up, priced in that high, we should have erased that and gone through the previous day because that should have wiped out the previous day's information. As we look at this in the S&P futures, when we get the around the clock price action, we're going to see this here. And you can see we have a cleaner chart. This is the response to the CPI. This is the response to PPI. But we should have stayed at or below yesterday's open. We should have remained below 64.67 and gone lower if we were really pricing in no rate cut. If we were really pricing in that that was a head fake, that CPI was wrong and we should not expect cheap money. Well, it didn't happen. In fact, we're creating a doji. This might be a tombstone doji, it might be a hanging man, and that would support the idea that we're going to have a pullback. But here we are in the overbought area for the month, and we've traded up to this level we're holding here. From a technical perspective, I would be looking to the downside, but I would have expected it to stay below 64.66 on the day. Instead, we just traded in a wider range, 42-point range on the S&P, and it looks like we're going to finish out the day pretty flat. Kind of a big zero, a big goose egg, despite the fact that we should have unwound everything that we had priced in. So that being the case, I'm looking at this and saying, it's a coin flip. Either I need to be betting on financials and the Russells, the small caps and the financials, or I need to be betting on staples and utilities as a defensive play. I don't see much around that in the current setup. Crude bounced up, it's the only thing that's really up solid today. But I don't see this situation as being one that we're going to meander around sideways. To me, this is just building up pressure, and we're going to either break higher on cheap money or we're going to reverse, and we want to go defensive if we're going to play bullish. So let's go take a look at those sectors really quickly, and we will start with the financials, and then we'll look at the Russell since the financials are so weighted into the Russells. We'll look at that. As you can see, financials are right here. We've been trading this channel quite a bit. This was not a breakout to record highs, but it was certainly a recovery off of these lows right back to center. Again, I think this is kind of a coin flip, but this coin flip says we could move up or down 240, 245, which is about a 5% move in financials. And what we saw in the market move, I'll do the IWM, and then we'll do the Russell futures again, so you can see the difference there. I've kind of got the same kind of situation here where we rallied up, IWM Russell ran all the way up here, we gapped down, traded down, and this is what I would have expected, but I would have expected us to stay below this close price. So we went to it, through it, and recovered. So that's recovery is what's making me say I'm not sure. If we stayed down below there, absolutely I'd have been targeting 220, but we recovered and defended the gap. And the Russell futures are going to look very similar to what we see here. Now bonds are acting like I would have expected. Bonds have reversed out yesterday and are holding near the low. So this is probably the closest that I would have expected based off news alone, price actions behavior. I would like it to be a little bit lower based off what we're seeing. It's the reason why I'm not ready to buy into bonds at this moment. Now we did some bond trading through here before, so I'm just going to protect it and hopefully collect the dividend. But if we clear this low, I'm expecting us to drop down and retest these lows. That is higher rates, higher yields. If we bounce here and go back up, great, then we have lower rates and lower yields, and then we will be able to know which way we should be betting, whether we should be betting on financials, or if we should be betting on utilities, or if we should be betting on consumer staples, which area are we going to go next. But it's a lot, depends on what we're going to do here. You can also see that same behavior in IEF, but where IEF is not a 24-hour market, you're going to see the gaps. It's the gap up, the trade back, right there to that previous gap. So gap based off CPI, gap down based off of PPI, returning to the previous day's close almost perfectly. This is not a high risk trade. I think you could certainly buy into IEF and put your stop down here, say at 95.15. But there might be other trades that are a little bit better as far as in utilities that might be a little bit more defensive instead of having the threat of selling off like we're seeing going into the market today. So if we look at the dividends offered by those utilities, we have SRE 3.13%. We have Dominion that is going to offer you 4.36. We have Nextera that's going to offer you 3.16. We have Duke. Duke is going to offer you 3.42. So these dividend stocks, well, utility stocks that pay high dividends, these are substitutes as far as returns on your investment. So like a interest rate payment or an interest yield, these are dividend yields, and they pay out very consistently. So I look at these main big players in the utility sector and say they're all 3, 4, 5%. The question is, can I buy in at these cheap? Are they at a support level, or are they confirming a breakout? Now Duke has pulled back similar to what we saw in bonds. It's a question mark for me. I'd probably want to see it pull back a little bit further and find a base to step in that. So it could be close though. SRE I like. SRE is closing up today despite what's gone on, and they pay that good 3% dividend yield. I like this one as a better entry for that trade. Dominion pulled back harder, and so definitely would wait until it pulls back and finds a base possibly near 60. And Nextera is holding into this consolidation, one of the highest dividends that we get, and it's just kind of holding in this consolidation. So SRE is probably my favorite on the setups because it's rising when everybody else is falling and it pays the better dividend. And it gives us an opportunity to play both utilities and a return on a dividend while we're also still participating in bullish moves and directional moves that can really pay out over time. If we see more movement into safety because of the PPI numbers today, or because of retail sales tomorrow, or because of consumer sentiment tomorrow, those are the kind of things that would push more money into these and drive the price higher, as well as collecting those dividends. Oh, and one more, EXC. I forgot to pull this one up. EXC is also not completely erased the previous day. It's here in the consolidation. I think it's a low risk trade, and their dividend on EXC is 3.57. So lots of dividend stocks inside of utilities that are a good substitute for bonds and gives you lots of choices. So again, we're at this inflection point. I'm not sure which way it's going to go. I'm willing to consider both directions, playing financials and small caps, or the opposite would be playing consumer staples and utilities. But if I want to collect that dividend while I'm waiting, I'm going to be focusing on the utilities, where I'm going to get 3.5 to 4% plus directional moves that could be 5, 6, 7, 8% over the next 6 months. That's going to do it for me today. Watch for price action tomorrow to give us some hints and clues of where we're headed next. And join me in the main room tomorrow as we look at some long-term plays. Have a great night.